Yeah, yeah. What they saying? I'm so divine, I'm so divine. Imperfection, perfection, my presence shine. My mental is parasailing maritime. They say I'm destined to read the palm line. Yeah, I'm so divine, I'm so divine. Imperfection, perfection, my presence shine. My mental is parasailing maritime. They say I'm destined to read the palm line. Yeah, I'm so divine.
Welcome to episode 19. Welcome to the H.G.R.G podcast. How we doing, DT? We doing G. We have a special guest today. All right. He's a CPA. His name is Kyle. We're going to go through a few questions. He's going to tell us about himself.
It's tax season, guys.
What he does. It's tax season. So hopefully we hit the questions that you guys are wondering about, especially when it pertains to real estate and business. So we kind of want to get the insight of someone that actually does this. You know, it's always good. It's always good to hear us talk about something, but it's even better when we bring a professional in, right? That's so, Kyle, if you want to introduce yourself to the world, please.
Yeah, sure. My name is Kyle Geer. I'm the principal accountant with Geer CPA PC in Pittsburgh, New York. I've been doing this for about 12 or 13 years on the tax accounting side, and I've been investing in real estate for about 4 years now.
Not only is it CPA, he invests in real estate. Yeah. So actually, if I could jump into a question, because you said that, being a CPA and investing in real estate, did that make you understand and learn what the benefits are as a CPA when it comes to real estate? Or is that just something across the board that all CPAs should know?
Definitely not something that I think every CPA would know. The firm I had originally started working for had kind of a focus in more commercial real estate than residential, but I had kind of a background in it. My parents and my brothers had been into investing, so I just I think having the financial knowledge has helped out in the real estate side, and kind of vice versa. And I think they are kind of related, which it's nice to have both sides.
If somebody's in real estate, you're definitely the guy to go to, because obviously you're in real estate and you're a CPA. Sure. You're on both sides of the fence. So you're definitely the guy to go see when it comes to real estate. Yeah. 100%. Now, DT, you've definitely worked with Kyle in the past, correct?
Absolutely.
How did that come to fruition?
There's certain people in life, when you see them, it's almost like an angel from God, right? They just have like this white cloud around them that they like it's almost like they don't walk. It's like they float to you. Like a lot of people use that reference when they talk about Prince.
Glow.
Kyle was the prince of your life. Is that what you're telling us right now?
As of very recent, it's been like that. Like Kyle kind of saved my life in a different way. And I'm nothing but appreciative and humble for him for that. And he's just an amazing person as an investor. Me and Kyle did some, he has rental properties, and I helped him out with that on the management side. And he's just been an amazing person from day one. And then, so I didn't know what he did when we first started dealing with one another. And eventually I found out through another associate that we do business with that's involved with real estate that, hey, Kyle does that. I'm like, get out of here. Cause I was going through some things on my end with my CPA. I was kind of stuck between a rock and a hard place. At least that's what I thought for a little while. And then I was like, you know what? I'm just going to blindly just shut it all down and just say, hey, please help me, brother. Help me. And sure enough, man, Kyle made some things happen. He canceled his day, had a meeting with us, sat down with us, took everything he needed to do, figured it out, got our lives together. And from this point forward, we're definitely on board with Kyle with everything. And obviously we're his biggest number one fans. We advertise for him. We're the ones saying, hey, you need somebody, this is the guy. And we're going to make sure we continue to do that. And I don't just say that obviously because he's on screen. It's really how I feel. He's like a genuinely good person. And he does amazing work in the accounting, the CPA world. He's not just like, the downstairs basement person who does taxes from Jackson Hewitt who did a class for 2 weeks. Like, you know what I'm saying? He's like the official, the real deal. You know what I mean? Holyfield. So yeah, definitely do have an experience with him. But I want to ask a question, Kyle. How did you? Obviously, I know you got involved with real estate. How did that experience go from your beginning? Because I want to kind of tap into that just very, very minimally, and then I want the rest of the episode to be based on what you do and the perks of even having a CPA, why a CPA, and how people benefit from a CPA and being involved in real estate, or even just in life. But quickly, when you got involved in real estate. How did you get involved with your team, the people who you deal with, your realtor, your whole team? What started that? What spunked that?
I kind of started out, just on my own, starting to look at properties here and there, and it's kind of a lot to try and do this and that on your own. And finally, we found a decent realtor. Kind of fell backwards into an attorney that we liked. We were managing our own properties for a little while, and well, I think that was a good learning experience. I'm glad that's not a lesson I'll ever have to learn again.
Absolutely.
How did COVID treat you?
We struggled. Definitely struggled. Cash flow was tight for a little while, certainly with the rentals. We did finally catch up. About middle of December, we actually got pretty squared away. We were able to get through some of the New York grants that finally kind of cashed in between November and December. Mm-hmm. And we got a few that are falling behind again, but I think the long and the short of it, we got through it pretty well. It could have been a lot worse, but my wife and I have always been pretty careful and conservative with the properties and that we've handled and made sure to keep a pretty sizable nest egg to make sure you can weather a storm. So we're fortunate in that route.
That's awesome.
Pay attention to what he just said. He's able to weather a storm because he has a nest egg. He has a safety net where if things go wrong or COVID hits out of nowhere, he has a backup plan or backup funds. So, I mean, that's important, and let COVID be a lesson. If you weren't like that before, if you didn't have, what Kyle had, which was a nest egg, learn from COVID because you never know what could happen. You need that. If you're going to invest, save some of that for the first couple of years, and then if anything happens, you're ready, you're ready. So definitely. Thank you, Kyle.
Awesome. So let's get into the questions. Let's talk about Kyle. Let's talk about, what he does, how he does it, and why this episode is super important. Please pay attention, people. Pay attention. A lot of stuff he's going to be giving up right now, pointers and things that I wish, a lot of people don't ask these questions. A lot of people don't even really know what questions to ask. So, pay attention. Allow this man to, share his knowledge, his wealth of knowledge with you. And, from there.
I got a question. If you own one property, do you even need a CPA?
That's a pretty good question. So the answer to, in general is it depends. If you only have one property, you probably can manage it yourself. But every long-term plan needs to start somewhere. And having a good CPA is more than just about getting your tax return filed correctly. It's about having that partner to kind of bounce ideas off of, having that relationship with someone that they can be thinking about you throughout the year and say, hey, I think this tax legislation is coming down the road. It might impact you. Here's some stuff we can do to get ahead of it. Mm-hmm. Sit down with them on at least semi-annually, and work towards creating a 3 to 5 to 7 year long-term tax plan. Whether you have whether it's just you and your job, whether you have one property, whether you have 50 properties, it's never too early to start planning and building that sort of relationship on your financial side.
Absolutely. It's important. Don't get ahead of the game. Why wait until you're in trouble. Almost like DT situation where, I know you had a CPA already, but you didn't have a CPA that prepared you properly. You didn't have a plan. So it's not only important to build your team, when we talk about here about attorneys and real estate, whatnot, but your CPA as well. That falls into it. Make sure you have the proper CPA so that way you can win in the long run. All right. So Kyle, with that being said, another question would be, how much does it cost to do your personal and your business taxes?
Yeah. So again, the answer is it depends. But if we're gonna speak fairly generally.
Oh yeah.
Yeah.
Kind of a basic tax return with one or two W-2s and maybe some investment income, interest, dividends. Probably looking base return in the $250 to $300 range. And then,
that's crazy. Let me stop you right there, Kyle. When I first learned this is probably like 10 years ago. When I first learned this, that a CPA charges them numbers. Because in my brain, when you told me a CPA, I'm thinking like, I can't afford it. Thousands of dollars, right? And I had my my personal tax returns, and I had one company at the time. This is it's like 15 years ago. And I was like, I can't afford that. And then somebody told me, like, bro, listen, do yourself a favor. If I ever see you walk into like a Jackson Hewitt or one of the, I'm gonna really do something to you, because you're gonna pay more for somebody who went to a class for 2 weeks than you're gonna pay for a CPA, generally speaking, right? So I love the fact that you just said that, because that's the misnomer that most people don't understand. It's very affordable. It's not out of your reach, and it does. There's not even a comparison of the wealth of knowledge that a CPA has compared to somebody who did a 2-week online course. And please, if you can expound on that a little bit, I would love that, because that to me, I'm like, tell me, you know what I mean?
So DT, are you saying don't get your taxes done at Walmart?
That's definitely what I'm saying.
Is that what you're saying?
Absolutely.
Yeah, to kind of expand on that, 250 to 300 is kind of the base, and then if you want to start adding on the rental properties, fairly safe bet is anywhere between $50 and $100 per property, kind of on top of that. Where in the range you fall kind of depends on how organized your information is and how much time it takes your accountant to get through it.
Yeah.
Generally, two or three properties, and the rest is a pretty basic return. You're probably looking at somewhere between $500 and $600. And in addition to that, like I said, this is finding the right accountant to work with, to help you grow your portfolio, is more than just filing a tax return once a year.
Right.
So then, the tax return is just one piece of the entire puzzle. There's a lot more that your CPA can do for you. You just have to ask the questions.
Right. I know I do it with you all the time. Hey, Kyle, you see, this is what our income is, and this is gonna be our taxable income, and we're gonna have to pay tax. Can I spend more money here? Spend less money there? Should I buy a car? Should I buy a house? Should I buy new computers for the office? Should I do some remodeling? And Kyle, he goes in, he says A, B, C, D, E. He breaks it down. That's why, so I've had accountants before, Kyle, CPAs, all of them CPAs. My first CPA was like a real old guy, super lax, old Italian guy. He was just like so nonchalant. Don't worry about it. I'll take care of it. Just give me your paperwork. And he did that. And me just being not really knowledgeable, I let that happen. So then he retired. And then my next accountant was a nightmare. A nightmare. Actually, Kyle had to redo everything that person did. So he had to go in and amend everything that the person did. So now, learning that lesson with her, I said to myself, I'll never do that again. I'm going to ask a million questions. And Kyle knows, when we sat down with him, me and my lady asked a million questions, and we still ask questions, and we still get. But to me, that's like one of the most important things, because this is like Kyle said, it's more than just a tax return. This is literally a partnership.
Right.
He's part of the keys to my success in my business. Because if me and him aren't on the same page, I could lose. Like, my business could fail, and I could be missing out. I could be paying more taxes than I should pay. I could be paying less taxes than I should pay. All those things have consequences. So you want to be right, even kill, so that you're where you're supposed to be. but yet not going above and beyond. You know what I'm saying? But it's more important because one of the questions that you asked that we were going to ask you was, you know, how do you, if you, what was the last one? If you cash flow and take a loss at the end of the year, how do you get approved for a mortgage? And when I asked Kyle that, he was like, that might be a question for a finance guy, because, you know, my job is not to get you financed. My job is to file your taxes and take care of your accounting and stuff like that. But with that being said, something that Kyle said was, you got to have a relationship, a rapport with him. You got to have a 4 or 5 year goal. So with us, we're telling Kyle, this is where we want to be in 4 or 5 years. So as he's preparing us for that 4 or 5 year goal, he has to start this year to show certain types of incomes, to show this, so that when we go for those mortgages, or we go for this and that and the third, we already had that plan in existence 3, 4, 5 years ago. And I can't even tell you enough how much I appreciate that, because before that, I had no idea. I thought I could file my taxes yearly and dictate how I handle that, and that's all it was. So thank you so much for that, man. I appreciate that. You're amazing at what you do, bro.
I hear a lot of people say, you know, they're worried that, you know, they can't afford an accountant, or, you know, it's going to be too expensive. And I usually might come back as, you know, can you afford not to have one? Because you'd be surprised, you know, how many people find, you know, how much money you're actually leaving on the table by, you know, not getting ahead of this stuff and not even knowing what you don't know.
Absolutely.
100%.
Absolutely.
Very true. Very true. Do you get a lot of questions, like people come to you like, can I buy a car through my business? You know, do you get a lot of stuff like that?
Daily.
Now, with that being said, I'm asking for a friend. Can you buy a car through your business?
It depends.
Is it, now, when you say it depends, what would it depend on? Is it like weight? Is it, you know, what is it have to be used exclusively for work, and all the mileage has to be, you know, taken down? Like, how does that work?
Yeah. So typically, you know, to take an auto expense on the business, the car, you know, to take 100%, you know, of a car on a business, it needs to be 100% business use. If it's less than 100% business use, then you need to start prorating the expense of the car by how much of it is actually business use. So that being said, there's also, you know, you have the option of taking your actual expenses or mileage. So tracking your mileage is important. So at the end of each year, we can take a look at, you know, which is most beneficial for you. You know, is it number of miles driven, or is it, you know, how much money the car actually costs you to keep on the road? So a lot of moving pieces when it comes to vehicle expenses. So
Yeah,
because I
know Grant Cardone. I was watching something, and he bought like a jet, because instead of paying the IRS, they were like, you know, you're gonna end up owing. And he's like, no, I'll just buy a jet instead of paying them, and use it for business. So I mean, if you could buy a jet, I'm sure you could buy a car as well. But like you said, there's a perimeter, there's an outline to it, you know, where that you have to follow, so that way it can be a write-off. You know,
is it beneficial though?
Some of us regular folks have to worry a little bit more about cash flow than, you know, just going out and buying jets.
It's so true.
What did you say, Jerry?
Is it beneficial though? Is it beneficial to add a car to business? Isn't it beneficial?
It can be, depending on the situation. Again, you know, the specific details of your business, of, you know, your particular tax position for that year, how you're using the vehicle, how long you plan on keeping the vehicle, all those things can kind of factor into, you know, what makes the most sense in terms of, you know, putting the vehicle on the books or having it as a, you know, personal vehicle that maybe you have the business reimburse you for mileage. There's a lot of different, you know, avenues we can go down with vehicle expenses.
Okay. So DT came over to you, right? Obviously, he had a CPA. He came over. It was a mess. You had to amend things. You had to sort through everything. You had to, you know, start from scratch and or fix mistakes from the past person.
Definitely fix mistakes.
What did you see that wasn't being taken advantage of as far as his real estate or his businesses when you started breaking things down? When you're like, man, he could have claimed this, or he could have done this, you know, and I'm surprised that CPA missed it. Was there anything like that? Was there any situation that you saw that he could have taken advantage of but did not? If you remember.
Yeah, without getting into too many specifics of an individual's return, there's
right.
That
we don't care. Tell the world. It doesn't matter. Tell the world about DTs. It doesn't matter.
And then not have multiple entities set up at this point, and there were ways in which we could have been having the revenue recognized on one of the businesses versus the other that was not taken advantage of to the best benefit that they could possibly get. There are a few credits on the personal side that were improperly calculated relating to that other income, because again, everything's related on a tax return. As soon as income starts shifting, the credit calculations start shifting. So those are the two biggest things, and we believe, Dan, we had an issue with the entity structure that was chosen. You're supposed to be an S corporation, but you hadn't been filing you as an S corporation, so we had to get that straightened out. There was a lot.
My God, listen, it was a simple question.
LLC. Remember, we had to create an LLC and get that on board and all that good stuff. For part of it, we had to create an LLC because of some of the properties. We had to figure that part out too. So yeah, no, it's a lot. It's a lot. That's why, obviously this is not a conversation that you're gonna, get in a 45-minute, 30-minute podcast, but just understand, even somebody like myself, seasoned, been in the business for a long time, but I don't know taxes. My business is not taxes. My business is real estate. I do real estate. I do contracting. I'm in that space. Within that space, I could play with the big guys. I could play with the little guys. We can all have fun. Taxes, it's like speaking a foreign language to me, and I'm okay with that. But at the end of the day, I got to be safe. We got to be safe.
You have a good team, though.
That's why you got to build the team. Right. Exactly, Jer. Yeah, you got to build the team.
So true. So, adding Kyle to my life, and the strange, not the strange part, but the best part about the story is that Kyle, before he was my CPA, we were doing business with Kyle as his management team. Right. So it just made sense when somebody was like, "Hey, Kyle does this. Why don't you, call him up and use him?" I'm like, man, that'd be phenomenal. He does business with us. Why would we not do business with him?
Right. Sure.
You know what I mean? So, and then now, as of recent, we're able to, as we do, anybody who asks about it, because we have a stream of people coming through H.G.R.G as well as through other business ventures. And, anybody who asks about, "Hey, Kyle, are you taking on more customers?" And Kyle always says, "Absolutely. Bring them on. So, no, it's phenomenal.
I feel a certain way right now.
Why is that?
My CPA has never sat down with me. "What's your 5-year plan?" No, they never asked me that at all. But I'm about to call him tomorrow.
My previous two didn't even ask me any of that. None of what Kyle is saying. That's why the experience with him was just like, whoa, hold up.
My CPA is gonna get a call tomorrow. It's gonna be a bad one, but it's gonna be a call. It's gonna be a call. I'll tell you that right now. I got a new CPA already.
You know what I want to do in 5 years? No, I don't understand why you're calling me Lance, saying that. I have this other CPA I spoke to, asked me about my 5-year plan, and you've asked me about nothing. But this is great what you're saying, though, because I may want to buy a bigger property in 5 years.
Right.
Now I'm over here thinking, I'm like, I may not be prepared, or my taxes may not show that, because when you're in business, it's different getting approved for a mortgage than what it is when you work a regular 9 to 5.
Absolutely.
It is not the same. There we go. Kyle, what is the difference when it comes to getting approval from someone that works a 9 to 5 and someone that owns businesses? Because there's a difference there. What difference is that?
Well, and to kind of make even further distinction, I own a business, very different, the business that I run day to day than someone who's a full-time investor, because, real estate investing, especially as a full-time gig, is a totally different world than most of the rest of the world lives in.
Right.
And the biggest thing, rentals are very good at generating tax losses, even when they're cash flowing positive. And it can be difficult to grow a portfolio and everything's based on a tax return, and your tax return's showing losses on a lot of your properties.
Yeah.
That's the way we, from a tax perspective, that's the way we want to set them up. So like Dan had mentioned before, my job's to keep your income on the tax return as low as possible. Yeah. And then we'll financial mortgage broker who can work with you to try and get your financing done.
That's so true. So, I just found out about a product today. Blew my mind. That there's a financing product that you can get approved for a mortgage based off of your bank statements.
Yeah. The percentage is higher 1 year, the percentage is higher 2 years, the percentage is a little lower.
I just found out about a product. I never knew about that product.
Yeah, Lance, you're not a CPA stuff.
That's for mortgage. That's for someone that's in the mortgage field. That'll tell you about that. And it's funny because I just learned about that myself. But the problem is the interest rate is a little higher. But I mean, it's a way to get in.
Right.
If you really want to buy property.
I believe they're called cash flow loans that are out there too. That you can look at getting financing based specifically on how the individual property that you're looking at should cash flow. Also, a pretty expensive way to get financing. I think you're usually looking at like 2.5% over.
Yeah. Right. Like right now it's like 6-7%.
Yeah.
Where the regular is 4%, something like that. So yeah, you're right. Because that's what he told me today. That's what I was on the phone with our friend today, and he told me that because I was mentioning to him that I was going to be on with you tonight. And he was like, oh, wow, and I was like, and he ended up mentioning that to me. But I got some questions for you, right?
Yeah.
So I watched I watch a lot of podcasts, a lot of them, right? So every podcast you watch when it deals with real estate, Rich Dad, Poor Dad comes up, right? And when you talk about Rich Dad, Poor Dad, the gentleman who wrote that, Robert Kiyosaki, he emphasizes that he owns real estate and he lives tax-free. He says, I live tax-free. I never pay tax. I do not pay taxes. I am a multimillionaire and I don't pay taxes. I will forever never pay taxes because I'm a multimillionaire and I invest in real estate. So I have a twofold question. Yep. Is that true? No, not in his life. I'm just saying, is that possible? Right. And let's just say a normal human being's life that, you're familiar with. Number one. Number two is, if it is, tell me how. Give me an example. And if it isn't, break that down for me if you don't mind.
Yeah, it's definitely not impossible. Especially when you're financing properties. It's pretty typical for at least the first 12 to 15 years for your property to be a tax loss year over year while cash flowing positive. And the reason for that is you get to depreciate the full value of your property over roughly 30 years with IRS in New York State. So you get that deduction year over year, and you're also getting your mortgage interest deduction. So for the first 12 to 15 years, that the interest side of that mortgage is pretty heavy. So you're essentially getting kind of doubling up on the expense of the property itself. That being said, kind of on the back end of the financing life, and if you're at 20 to 30 years, that sort of ballpark, typically are going to see you hope to see some taxable income at that point, if your property is performing well. At the same time, a lot of people will dump their properties at that point, or dump them and reinvest in another property and kind of start that cycle over. At that point, you're not paying no tax. When you start turning properties over, there usually is a taxable event, but you're talking long-term capital gains rate, not ordinary income rate. So even though at that point you might be paying some tax on it, it's significantly less tax than you'd be paying in the same amount of wages, for example.
Gotcha. Okay, so it is possible. It's just a matter of obviously having the CPA that can walk you through that, point you in the right direction, and obviously do it the right way. But there's levels to this, right? You can't own one property. You have a 9-to-5 job, you make 80 grand at your job, you own one rental property and think, okay, I don't have a tax return because I own a property. Is that possible?
No. So if you're not a real estate professional, you're the losses you can take as on your real estate in any given year is $25,000 if your income is below $100,000. That $25,000 limit is reduced, if your income is over $100,000. And actually, when you hit $150,000, all of your losses are suspended. So that's kind of the biggest catch to be careful of if you're a passive real estate investor. But your day job, or your combination day job, if you're married,
yeah.
more than 50,000, you can get caught in a little trap there where you have tax losses from your properties that you can't actually take advantage of in the year that they happen. Not that those losses, not that they go away per se, but they are carried forward until you have other passive income to net against it, or you sell the property.
Gotcha.
So how in the world does somebody that, plays that game, if they're not purchasing everything with cash, like how are they getting approved for things? How are they getting approved to buy a new car? How are they getting approved to buy properties? Anything that has an approval system, how are they getting approved for things? If they're always taking losses, never paying taxes, how do you get approved?
Some people will put the properties they have in a corporation. Then the financing in the corporation ends up separate from your personal finances. Downside to that, your corporation doesn't have a credit history, so typically your rates are going to be higher if you're financing through the corporation, at least in the beginning, until your company starts establishing a credit history. Cash, people buy a lot of stuff with cash at that point. I think the key, when you're looking at buying your personal cars and stuff like that on financing, is to keep your credit clean. Be smart about building your credit history. Make your on-time payments. Don't carry credit card balances. Be careful about signing up for that store credit card, because they'll give you an extra 15% off when you're making a purchase. All that stuff has a relatively long-term impact on your full financial package when you're going to find financing.
Right.
Gotcha.
So I got a situation. Go ahead, man. You want to talk?
No, I was going to tell him I need you to help me build 2 offshore companies. Kyle, we'll talk after the show. Go ahead, DT.
A segue from that, right? So flipping, right? Big part of what I did at a certain time, right? And I did a lot of hoop, jumping through hoops and figuring things out. And I had to kind of slow pump my brakes because my tax bill got out of control, the capital gains. And I was, it was kind of going so fast. But at the same time, I'm not sure if I had this is way prior to meeting you, Kyle. So I'm not even sure if I had the right advice. If the person that was telling me told me right. Honestly, I really don't know. So for somebody like, let's say I wanted to get back involved with flipping, right? Let's say I flip 20 properties, 10. Let's use the easy number, 10 properties a year. Okay. On average, I see a profit of $25K. Right. So you're talking $250,000 in potential income, right? I'm going to get slammed 40% of that for my tax bill.
Yeah.
What's the point? I mean, can you help me? Or am I missing something?
Yeah. The flipping's kind of an interesting offshoot of the real estate market here, because you're basically paying your ordinary income tax rate because you're not holding the properties long enough typically. So if you hold a property for less than a year, it's a short-term gain. It's treated as ordinary income. Mm-hmm. If you're able to hold those properties for 12 months and a day, now you're looking at long-term capital gains. So you're probably cutting that tax bill by at least half.
Mm. Yeah. Yeah.
Yeah.
Something you don't know.
Try
They don't
to
teach
So
you.
you got to be a 1 year and a day flipper.
Yeah, 1 year and a day. 1 year and a day.
That's what you got to do. You got to hold it.
And
which is tough, if you're carrying finance,
hold costs and all that stuff, it gets expensive. Absolutely.
unless I have worked with flippers in the past who did legwork to maybe get it rented out for a year and then sell it, and then you're looking at long-term gains. It's not that's a strategy for everybody, because cash flow can be tough. You get a lot of capital wrapped up into your flips, and sometimes it does make more sense to just eat the tax bill to keep churning, and to keep the cash flow going.
That's kind of why I fell back full hearted into like the flipping thing. And unless I had something like a 1031, that's when I went hard with it, because I knew I could do something with a 1031. Can you expound on a 1031 the right way? Because if I explain it, it's probably not going to be the right way, the way I understand it. Please.
Yeah, so 1031 exchanges are real high level. It's a way to basically sell an asset and purchase a similar asset, while avoiding a taxable event on the sale. Typically involves using a third party as a purchaser, or an agent rather. And the biggest kicker there is the properties have to be of similar type. They can be difficult to do.
Yeah. Like example, if you have a residential that you're selling, you have to purchase a residential. You can't sell a residential and purchase a commercial.
Correct.
And vice versa. If you have a commercial, you can't purchase a residential.
Correct.
Okay, so these are things I don't hear about. I mean, I hear about 1031 exchange or whatever, but I don't hear about the do's and don'ts of it. So I didn't, I'm going to be honest, I didn't realize that you couldn't go ahead and take it from residential to commercial.
Yeah.
Or from commercial to residential.
Mm-mm.
I thought it was just a tool to get whatever you want.
No.
And utilize it.
The biggest thing, which is a lot of people, that's why we're doing it. The biggest thing, the first thing I learned, let me tell you that. So I had a property that I flipped, and I made like 70 something thousand. It kind of fell in my lap the way it happened. It was one of the best flips I've ever done till this day. I made like 70 something $1,000 on this flip. And when I did it, I just so happened to be talking to my attorney about the whole situation. He was like, "Are you going to 1031 it?" And I was like, yeah, I think so. And we kept the conversation going. And when we left, I was like, what the hell is a 1031? So the next day I reached back out to him. I was like, "Hey man, Eric, you mentioned to me something about, you said 1031, and I was just so high in the moment. I was so happy, for what was going on. I don't know what that meant, but I just said, yeah. So can you explain that to me? So he explained it to me. So at the time when I did it, me and my wife had just got married, and we were looking for a primary residence. And what I sold was a residential home. But in my brain, I got 70 something thousand. So I'm like, oh, I'm about to buy investment properties. I'm going to go buy like a complex or something. Like I'm going to try to buy like an 8 unit, 6 unit, 7 unit. So he was like, no. You can't do that. You can't do that. You have to buy residential. So we ended up buying a house for ourselves because of that. So that's when I learned that lesson, that you can only buy what you sold, that same property type.
Yep.
Got it. Is there any way to avoid capital gains other than 1031, or
12,
you just got to eat it?
12 months a day.
No, capital gains still is 20%. So it goes from 40 to 20%. I'm seeing if there's a way to get around it at all. Yeah.
1031s are usually the best way to avoid that.
Gotcha. And it's got to be residential to residential.
But the other best way is to die. whoever property can step up and base it.
Right.
Well, it won't be the latter on this one. I'll tell you that.
Yeah. I know a gentleman who I used to work with. I don't know, many years back, but he did a lot of commercial properties, multi-units, like, 20, 30, 40 units. He bought a 47 unit complex, right? And it needed work. So I think I want to say he paid like 1.1. The property needed, it needed a lot of work. He put like another almost 900,000 in the property. When it was all said and done, he sold it for like 4 million, right? When he sold it for 4 million, his tax bill was going to be like 1 point something million. Because he did this in like 8 months.
That's the one you want to wait on.
Yeah.
So, but he in my brain, he killed the game.
Yeah.
He was like, no, I'm 1031 exchanging this and I'm buying another commercial property for 1.2. So he bought that complex for the same money that he would have paid Uncle Sam.
Yeah. Smart.
Killed. I was like stuttering. I couldn't even believe it. I was like, oh. And that like, that's a whole different language. And obviously it's not easy to do it because when you do, just to be clear, when you do a 1031 exchange, while you're doing the sale, you have to declare that.
Right.
You have your attorney know. Yeah, exactly.
90 days or something like that. It happens fast.
You only got a 90-day span. So it's not like you can sell a piece of property right now and make 100K and then just sit on that 100K for 6 months. No, while you're in that, you doing that sale, you have to let your attorney know, number one, that you're doing that. And you got to find another property of the like type within 90 days.
And what happens if you don't? Let's say you're under contract for, or maybe it falls through and you're beyond that 90-day mark.
You owe capital gains taxes.
Yeah.
There's no way around it.
If you miss the 1030 window, then you'll owe the capital gains tax on it. Yeah.
Even if you were under contract with something and it fell through, maybe not the cause of you, right? It doesn't matter. There's no exceptions.
No exception.
With that being said, Kyle, let me ask you this: two more questions, and then I'm gonna leave it to the floor because this interests me the most. This is like what, excuse me, stuff that I have conversations about regularly, and a lot of times I'm ignorantly speaking, but I soak all this up. If what are the most
Come on, get it together, DT.
Yeah, what are the questions that you're asked, or not even the questions? What are the things you see the most in real estate taxes that people either don't take advantage of enough or take advantage of too much? The two things that you see in that range.
I think for the casual investor who tries to self-prepare, I think the thing that tends to be missed the most is those carry forward losses that I told you about. Because if you're bouncing around, you do TurboTax one year, then the H.G.R.G block the next year, and then we're going to go back to TurboTax the next year. If you're bouncing around with all these self-preparing types of softwares, if you're not carrying those losses forward every year, you lose them. They get lost.
So if you use TurboTax, it's real fast, right past your money. I got you. I'm picking up what you're putting down, Kyle. I'm picking it up.
Okay, so consistency in whatever avenue you go to, right? For filing of taxes. If you're not going to be consistent with that same entity, at least carry over all the same information.
Yeah, and then you see it a lot. Where you take a look at 3 or 4 years of a new client's tax returns, and they had multiple different softwares that they'd used through the past, and you're saying, 2017 and 18 you had these losses in TurboTax, and they got carried forward these 2 years, but then you went to the H&R Block software and you forgot to enter in your carry forward losses, and now they're gone.
Okay.
So, and if we're not still inside the IRS amendment window, they're gone forever.
Right, they're gone forever. Yeah. So that's the one that you see that people don't take advantage of enough, right? Yeah. What is the thing? Go ahead. I'm sorry.
That's the one I see most frequently, I think. Got
you. And then what would be the one that you see that people maybe stretch that line too thin, or it's the biggest misconception in real estate taxes?
I think a lot of people have the generalization that real estate investing from a tax perspective is kind of, the Wild West. Here's stories of, massive tax losses, with huge, positive cash flows. And not that that doesn't happen, but, your first couple of properties that you buy, it's not going to wipe out your whole tax bill.
Right. Absolutely.
So what about the 1029 exchange? I just made that up, guys.
1031.
You know what? I'm throwing it at the wall. You might be, the 1029 exchange is, very similar.
He just created the Wild West for you. He just made up a whole new one. Oh, that's hilarious. That's hilarious.
This is why CPAs don't work with me. I'm one and done with CPAs.
Mental note. When you get an email from this gentleman,
ignore.
Yeah. And then, hey, what happened? Oh, I don't know. Let me check my spam. I'm not sure.
No, Lance, did you contact me within business hours? Yeah, absolutely. Go back and check. Jerry, you got any questions for Kyle?
So I just want to bounce back off what DT just said. What is the biggest credit that we could get in real estate? What is the biggest that you see that we always could get 100%? This is the biggest. You're always going to get this credit. This is the credit that we always get, and everybody gets it if we get in real estate, or the majority gets it in real estate.
And the two biggest expenses, that everyone gets that really drive the tax losses year over year is your mortgage interest and taking the depreciation on the property. And the fact that you can take depreciation and the mortgage interest, in the same year, because that interest is, so front weighted in your mortgage, that's what really drives those tax losses, particularly the first 8 to 10, even, up to, the first 12 to 15 years you own the property. It's really those two pieces that drive those tax losses while still allowing you to typically be cash positive.
So if I don't want to pay taxes, and that's a goal of mine through real estate, am I better off financing the properties? Because I own properties outright as well. Should I have financed them so that way when it comes tax time, it's more beneficial? Or how does that look?
Potentially, yeah. A lot of people go that route, like to have most of the properties financed to kind of have that additional mortgage interest expense. It also helps, stretch your dollar a little bit more. You can have, do you want to have 5 properties that you own outright, or do you want to have, 15 that are financed?
Did you hear that, ladies and gentlemen?
Right. Would I be wrong to say that I own I love the fact that I have mortgages or refinance these properties, even if I paid cash for this property up front? I did the Bird method, right? So I bought, rehab, rinse, repeat, all that good stuff, refinance, and I walk out with all my money back in my pocket. Now I have a mortgage, right? And obviously I keep repeating the thing. So would I be wrong to say that that's but that's a great way to go to try to live tax-free, period? Is that a wrong misconception, or no?
No, it's definitely a decent way to go right now. That being said, who's to say what happens the next 3 to 5 years? We're talking interest rates at 4 and 5% right now.
Right.
You start, getting, you think 20, 30 years ago, you had mortgage rates, 10 plus.
Right.
That's a different story.
Right. Yep. So with the method he's saying, he's doing a refi cash out. So he's pulling money out.
Yep.
What does he owe the, Uncle Sam when he pulls that money out?
Nothing.
Tax. Hold on, Jerry. What was that again that you said? How much do you owe?
Refinance.
You put it in your pocket, you walk away.
Yeah. Tax.
That's it.
And you know, like a real example, which we shared in our podcast a couple of times, is, you know, we're not going to give us specific numbers, but like a real scenario, but we create a fluff one, if you will. You pay 40,000 for a property, you put 20 into it, you refinance it. Let's say, you know, it's 80,000 worth, you get 65,000 back. You get all your money back plus 5,000 in your pocket, tax free. You know, if you create a bigger scenario where you make 40 or 50,000 on your refinance, you could take your money back and take that additional 40, 50,000, invest that in a property. Now you got that money tax free, rinse and repeat, and just keep adding to that. Obviously, it's not that simple, but, you know, and essentially the numbers are that's a real scenario.
Yep.
Yeah. Okay.
It was definitely. Well, I would say this, Kyle. What advice would you give? Because we're a real estate podcast, so you know, and that's what we hang our hat on. What advice would you give real estate investors when it comes to, you know, doing their taxes or getting with a CPA? What questions should they ask to make sure they are getting the right CPA, you know, when they're vetting them?
Yeah, definitely ask kind of up front, you know, try and find someone who does a decent amount of work in real estate. There are plenty of them out there. I'm not going to pretend I'm the only one in Rochester that does it.
It's only Kyle, guys. It's only, forget what he just said. It's only Kyle.
He's right. And I'll say until he's not taking more clients.
I think most importantly, ask the questions that will make you comfortable that the accountant you're working with wants to be your partner. You know, he wants to help you achieve your goals. Isn't just meeting with you once a year, banging out a tax return, and then I'll see you next February. You know, planning doesn't work retroactively. If you're not being proactive, if you're not setting goals, if you're not communicating, it doesn't work. You're going to leave money on the table.
Absolutely.
And I do have one more question. You know, we got to respect the CPAs. In the busy season, how many hours a week are you working, man, to get everybody right? What's that look like?
So we're early February right now, so we're not, you know, in the real throes of it. I'll be at about 75 this week, but probably by the end of February we'll be 90 to 100.
Mm. So I sent Kyle. I was talking to Kyle last week about a property, a couple properties actually, and he was like, "Oh man, April 15th."
Yeah. April 15th. Okay, 16th.
He was like, April 15th, I'll be done with what I'm doing. April 16th, I'm ready to go. But right now, I can't even think about another property until April 15th is done. So I took that, and it was a good property. It was two good properties, and I sent it to him, and this is why I laughed, because Kyle's funny. So I said, Kyle, you ready to buy? He was like, no, I can't. April 15th, right? So I was like, oh, just so you know, by the way, I was just looking at these two properties, and then that was it. I cut conversation off, right? So a little while later, he's like, send me those addresses, please.
And so we got the hours that you work. You know, you have a lot of people that are late and procrastinators. When you feel like your season's up and it's finished, how busy do you get after that? When everyone starts to knock on the door and they start ringing your phone and go, hey, listen, I know I was supposed to do it on this date, but I'm late. And how do you go about handling that?
So, you know, we have our pretty steady client base. So everyone that, you know, comes to us year after year, you tend to figure out who's going to be late and who's not. Everyone gets an extension filed, you know, if they're not in by, you know, second week of April or so. So no one's late. They just get extended. Typically, you actually see kind of a drop off, you know, until at least like June. You know, if people don't have it done by April, they're not in a big rush. You know, start reaching out a couple weeks after the deadline just to make sure people, you know, didn't forget that, you know, still got to file tax returns.
Right. I keep having questions here because I don't. This is not my strong point at all. Right. You know, when it comes to taxes or really knowing, you know, the ins and out of what a CPA can do and cannot do for me.
Sure.
So let me ask you this. What's the craziest file that ever hit your desk? Somebody 5 years behind that hasn't done anything, 10 years behind that hasn't done anything. What did that look like for you?
Great question, Lance. That's a great question.
Oof. It goes back a few years. I used to do a guy that owned a couple of restaurants, and he was the classic CPA horror story. He'd come in with, a stack of paper boxes full of receipts and say, have at
it. Boom.
I'll be back in a month.
Yeah, exactly.
Wow.
You can have it done by next week, right? No. Yeah. It's
Not gonna happen.
You can see when he comes in, everybody knows it. It's Jeff again. God.
Yeah. Call the interns. They got to start.
Everybody's working late this week.
Yep.
Wow, that's great.
I'm like, well, listen, I've been satisfied with the questions I've had. DT, if you have any, Jerry, you good here? Kyle, we appreciate you. We know that your season's just getting started, and you, like you said, you've worked 75 hours, a week, and we appreciate you taking the time out to spend it with us and to educate the viewers. So, once again, H.G.R.G family, we're going to bring people like this, to educate you guys.
Please support. Please. Kyle, do you have social medias, websites that you want to mention there? Because obviously we stamp H.G.R.G 100% solidified stamps you. But please, if you have like a social media website or something you want to say to go out so that people can, reach you at, please do that if you don't mind.
Hit him, Kyle.
Got our Facebook page. You can check the information out on the website. It's geertax.com. So GEERTAX.com. That'll have all of our info, contact info, email, phone number, office location. If anyone out there has questions, feel free to call the office. I'd be happy to discuss with you.
There you go. And we have 1 million subscribers, so people are going to call.
And if you mentioned H.G.R.G to Kyle and his team are very obviously aware, and obviously they give you the red carpet treatment as they always do with all their customers. So knowing H.G.R.G and being part of our team as well is a one up. But Kyle, man, I can't thank you enough. And Lance, go ahead, do what you was going to do.
No, absolutely. And just to put the cherry on top, if you do say H.G.R.G when you call them, they'll find a way that you don't have to pay capital gains. So anyway, guys, we appreciate you. Thank you for tuning in, H.G.R.G family, and we'll see you on the next one. Thank you, guys.
Thanks, guys.
What they say? I'm so divine, imperfection, perfection, my presence shines. My mental's parasailing maritime. They say I'm destined to read the palm line. Yeah, I'm so divine, imperfection, perfection, my presence shines. My mental's parasailing maritime.